So bank reconciliation statements. The topic is called preparation of a bank reconciliation statement. Preparation of a bank reconciliation statement. This is a combined class. So starting Wednesday and Saturday next week, Wednesday and Thursday next week, we shall be looking at something different. Or we can because we are supposed to be moving at the same pace. I will see what to do. Otherwise, combining you today shall mean that after Wednesday, we won't be at the same pace. But I will see what to do. We can decide to use the Thursday for purely revision. We can revise areas where we saw that we are weak. I've seen some areas where members have complained and they need to do some kind of revision. We can use the Thursday to revise some other stuff as a combined class, such that whatever I'll teach on Wednesday is taught on Saturday, and then we move still at the same pace. So when you see me creating this time, it's because I really want us to have some extra time to revise together, such that by the time you go for the paper, indeed we are ready to excel, not just to pass, but to excel. Okay, bank reconciliation statements. Those of you who have studied packs, it is on page 153. Page 153. That is where you'll find your reconciliations of bank reconciliation. So bank reconciliation, normally, I don't know, you've got to understand the language. Do we have any bankers in this class? Anyone who works for a bank in this class? We don't have any banker. Okay. What I wanted to bring forward is the fact that it is only a few things that we need to understand in terms of the language that is used. If you happen to have seen a bank statement has a debit, a credit, and balance. Those are the three specific areas that you expect to find on your bank statement. You find that you have, okay, the particulars, those are the details. You have a debit, you have a credit, as well as the balance on that bank statement. Now, we have already looked at what we call a cash book. And again, the cash book, it also has the particulars, it has a debit and a credit. Now, a cash book has both a debit side, where we have a cash column and bank column, and at the same time, a cash book has a credit side, which has both cash and bank. I believe we all understand those. We have seen them practically. We have seen how a cash book is supposed to be prepared and how a bank prepares a bank statement. Now, if we have a cash book for a specific bank, if we have a cash book handling a specific bank, meaning that the transactions, maybe the one thing you have to understand as we do these reconciliations, we are targeting a cash book together with one bank statement. I am reconciling a cash book or transactions recorded in a cash book as well as a bank statement for a given account. So the understanding is that whichever transactions that are happening in the cash book should ideally appear on the bank statement, or transactions appearing on the bank statement should be appearing on a cash book. Now, in most cases, you find that the balance that is appearing on the bank statement is far different from the balance that you have on the cash book. The balance you have on the cash book as the balance carried down should ideally be the same balance that you expect to find as the balance at the end of the bank statement. Those two should agree as long as it is a same account, it is the same account, and the transactions appearing in the bank statement are the ones expected to be in the cash book. Now, bank reconciliation normally is the comparison of a bank statement balance with the cash book balance. We are comparing a bank statement balance together with the cash book balance. This is how these two look like. I just want to make some kind of an illustration for people to appreciate and see that we are supposed to debit credit here and there for us to come up with a reconciled statement. Assuming this is my cash book, I have a cash book which has particulars. I have cash, bank, then I have again pictures, cash, bank. This is a long. I think that this is my cash book. If we happen that we have received money, we have received from cash sales. Assuming we have made a cash sale and we have received 10,000. Assuming we have also made our payables. When we pay payables, money goes out to the bank. We have received money using cash and bank of 20,000. Where we have also paid money, we have paid our payables, Ugandan shillings 5,000 through the bank. If that is the case, I am going to balance off my bank, my cash book. When I balance cash, I have a balance carry on here, add the cash of 10,000, sorry. And under the bank, because there is this payment that you have made, then you have 15,000. You have 15,000. Those are the balances carried down that you have in the cash book. Now, assuming you're looking at a bank statement. Bank statement. Now, these are particulars. Debit, credit, balance. That is my bank statement. That is how it looks like. That is how a bank statement looks like. Now, assuming bank statements, the bank is like that, and the balance brought forward from the previous periods, we have a 0. During the period, when we receive money, now this is where I was telling you that you have to appreciate the language. When we receive money in the cash book, we debit. Every time we receive money in the cash book, we debit. We are showing that money has been received, and therefore it is an asset which is going to increase. Therefore, we debit our cash book. That is when we receive money. When we pay out money in the cash book, we are going to credit the cash book, showing that an asset is reducing, cash is moving out, and therefore we have got to reduce it by passing a credit. That is when we have our cash book. Now, when we get to the bank, for purposes of looking at the bank statement, every time we receive money, it is a credit that has come in. Therefore, when we have a credit, when we receive money, we are going to pass a credit transaction. In the bank statement, it is a credit which corresponds to the debit in the cash book. In the bank statement, the debit shows that money has been removed. Those of you who have accounts, whenever the bank removes money, whenever you remove money you yourself from your account, the bank will send you a message and will tell you that your account has been debited by this amount. When your employer pays you and money is put on your bank account, the bank again will send you a message and say your account has been credited by 1 million. Now that is the language I want you to understand, that every time we receive money in the bank, we are crediting our account. Every time money is going off our account in the bank, the account is debited. The account is debited. So understand that language, because at the end of the day, if you don't understand the language, you're going to get confused. You're going to get confused. So in this case, in comparison with what I have here, the balance brought forward is a 0. If I had a balance brought forward here in the cash book, I would also have it here in the bank statement. Now, on a certain date, we had some cash sales. We had cash sales. Now, the cash sales we saw, 10,000 was received using cash, so we have it in hand, and we also have some money that was paid in the bank. So this money that was paid in the bank should be appearing on the credit side of the bank statement, meaning that our account was credited by that amount. And at the same time, we have seen that as we have this, it means the balance, the balance that we have on our account is 20,000 at that point, because our account is credited with 20,000 because of this money that was received in bank, which has been recorded in the cash book. So our bank credits our account, and then we have a balance of 20,000. On another day, we paid the payables 5,000 through the bank. So you come here and say payables. We paid. Once we pay, money is going off our account. Therefore, we have 5,000 here. Now, the 5,000 that we have paid off is a debit because money is going off our account. So once I record the 5,000 here, that is expected to reduce my balance that I have to 15,000. Therefore, at the end, my balance is 15,000. Now, this is the same balance that I have here in my cash book under the bank. I am not looking at this that I have received in the cash unless we say that this money was also deposited on the bank account. That is when it will appear on the bank statement. But in this case, before it is deposited, it is still held. We are still holding it as cash, and therefore we cannot have it there on our bank statement showing. So the same balance I have here, balance carried down, is exactly the same balance that I have here. That is the ideal situation when you're looking at the cash book vis-a-vis a bank statement. So at all times, the expectation is that the two should be the same. They should be matching. The bank statement and the cash book should have the same balances. But oftentimes, you're going to find that they are different. You find that the two are different. The cash book and the bank statement are two different scenarios. And if the two are different, then that means indeed we cannot arrive at the same position. We must find a solution to ensure that we reconcile these two. We must come up with a reconciliation statement to see in situations where we have some deviations, those deviations are actually corrected. So the differences between the two balances normally arise from errors that we commit, omissions, some transactions which are not recorded either in the bank or in the cash book, as well as timing differences. You're going to find that you have some timing differences of transactions. A transaction has been entered in the cash book, but the bank has not received the check. So the bank cannot credit or debit your account unless it has an instruction. We do not have any specific instruction in the bank, and yet here in the cash book, you have received something or you have paid out something. So that means because of timing differences, some of these, at the time when we obtain our bank statement to reconcile, you find some differences. There is a need for us to ensure that we reconcile such differences. And these must be explained for the reconciliation statement to be complete. For the reconciliation statement to be complete. So we are saying that since on several occasions, the cash book balance that does not agree with the bank statement balance, then we are going to perform what we call a reconciliation. We are going to perform what we call a reconciliation. That is what I wanted to first explain for members to appreciate. I hope we now appreciate when we say the bank has credited an account, we know where the amount is supposed to be. The bank has debited an account, we know where that transaction is supposed to be. When we say we have recorded a transaction in receipt of money, we know where that money is supposed to be in the cash book. And once we pay out money in the cash book, we know where it is supposed to be recorded. And even the issues bringing about the differences, the timing difference, the omissions, the errors that are committed, we can easily commit them or correct them. Let's look at the purpose of a reconciliation. Why do we do? Why is it even important for us to do a bank reconciliation? Purpose of a bank reconciliation. We are saying that it facilitates cash flows in the business by correcting errors in the cash book. Now, where you have some errors, and probably the errors are showing that there is money, they are showing that you have some errors and your cash book is showing you as if you have less amount. Once errors are corrected, once errors are brought to book, then you can know that you have sufficient money or you have less money. That is where we say that it facilitates cash flows in the business by correcting errors in the cash book. Either once you have some errors, your balance is going to be less understated or high overstated. And once that is the case, then we know that once we have corrected these errors, our cash flows are going to be facilitated in showing the clear view of the position that we have at a certain moment. Secondly, it strengthens the organization's internal control systems through prevention and detection of fraud. We know that once we have performed the bank reconciliation, if at all there are any transactions that were not recorded in the cash book, or there are any transactions which were recorded in the cash book, clearly showing that money was going out, money was being paid out, we would be asking, why don't we have it in the bank? If the control is to make all payments through the bank account, why did we make payments using cash? All those will be questions that will be posed for you to detect any frauds, to detect any errors that were actually committed. So we are saying that it strengthens the organization's internal control systems through prevention and detection of fraud. If the policy is that all transactions are supposed to be paid through the bank, where you have payments which are being made using cash, you are violating the control. The control is to ensure that all transactions are paid through the bank. So if someone pays using cash, then the control is being violated. And there you can pose questions. Why did you make, if you're an auditor looking at such a transaction, there you're asking, why did you pay using cash instead of using bank? Because such a transaction cannot be traced on the bank statement because you paid using cash. So it is an internal control and so many other controls surrounding that kind of arrangement. Errors detected on the bank statement are immediately brought to the attention of the bank for appropriate action. There are cases when you actually have some errors that have been committed by the bank. At one point, we are going to look at the principle. At one point, we are going to look at the principle. So, what happens? Just a minute. We are saying that errors detected on the bank statement are immediately brought to the attention of the bank for appropriate action. And what we do, we say that where we have errors that have been committed, the principle or the assumption is that a bank never makes errors unless it is expressly said. Errors detected on the bank statement are supposed to be immediately brought to the bank in the event that indeed guys, just a minute. I see my voice is here. So in case we have any errors, and these errors have been detected on a bank statement, then such errors are immediately brought to the attention of the bank, and then an appropriate action is taken. Now, I was telling you that we have a principle where we say that banks never make mistakes. Banks never make mistakes. It is only when it is expressly said. I want you to go with a mentality, especially when you're looking at these bank statements, that banks never make a mistake unless it is said that a bank clearly made a mistake. So errors that we shall find are errors which are expected to be made by the accountant in the cash book. The errors which have been made in the bank will actually be clearly said. So a bank reconciliation normally helps in detecting such errors. Let's look at some of the key definitions that we have under bank reconciliations. Key definitions. Key definitions. There is what we call a check system. It is what we call a check system. And it so happens that these days, these checks are used in different situations. They are used in different situations, especially when we actually want to ensure that we pay. We give an instruction. A check is just an instruction that requires the bank to transfer money from one account to the other. And within the check system, we are going to see the different instructions that are normally given alongside with that check. Which instructions, what kind of instructions do we have to ensure that the check is redeemed in a way that it is supposed to be redeemed? Someone is making noise around this place. Just a minute, guys. It is so disrupting. It's making a lot of noise. So let's continue. I was saying that we normally give a check, and this check is kind of something like an instruction. It is an instruction that is given to the bank for the purpose of transferring money from one account to the other. So through the check, we always have a number of different terms or terminologies that come along with it through the check system. And one of them is check clearing. We have check clearing. What do we mean when we talk of check clearing? Check clearing. Check clearing. Now, the term check clearing means normally it is the process by which banks and financial institutions exchange checks to settle payments between customers. Check clearing means, or it is a process by which banks and financial institutions exchange checks to settle payments between customers. When you deposit a check into your bank account, the bank sends it to the check issuers through that process that we refer to as check clearing process. So every time you have a check, you have received a check. Once you receive a check, you as an individual, and that check is paying you, that check, the moment you present it to the bank, it has got to be sent to the issuer. The bank, like the bank that is issuing that check, to ensure that there is actually a transfer of funds from the previous account to this account. So we say check clearing is the process by which banks and financial institutions exchange checks to settle payments between customers. We have two different customers involved. One of them is paying the other with a check. So the process that we go through to transfer these or to transmit these funds from one account to the other is actually being referred to as check clearing. That is where I'm saying that when you deposit a check into your bank account, the bank sends it to the check issuer's bank through the clearing process to receive the funds. Through the clearing process to receive the funds. So check clearing is that. We have what we call check crossing. Check crossing. We have what we call check crossing. I am very sure many of you who have looked at different checks, you have already seen certain checks being crossed. There are certain instructions which normally come along with that check. You have a check which has been crossed. You have a check which has been crossed, and there are some words written in those crosses. There are some two parallel lines which are appearing on the check. Sometimes you have a check and it has parallel lines which have actually been put on the check. And sometimes you have two parallel lines in which there are some words inside the check, inside those two parallel lines appearing on the check. So we are saying that check crossing is a practice used to make a check more secure and ensure that it is paid into the bank account of the intended recipient. Every time you see those crosses, they are not for formality. It is not a design, but it is an instruction which is clearly understandable to the bank that redeems that check. So we are saying that check crossing is used to make a check more secure. How does it make it more secure? It is used to make a check more secure and ensure that it is paid into the bank account of the intended recipient. When a check is crossed, two parallel lines are going to be drawn across the face of the check. This indicates that the check can only be paid into the bank account and cannot be cashed over the counter. When you put, if you find a check and a check has two parallel lines, that is an instruction that it communicates that this check can only be redeemed, or it can only be paid into a bank account, and it cannot be redeemed using cash. You cannot pick cash and give this person in cash. But if you find that a check does not have any such instructions, it means the bank can pick cash and give it to the recipient, the owner of the check. So every time you have a check, please look at it clearly. View the features that are there. Once you find that a check has been crossed with two parallel lines, that simply means this check cannot be redeemed by cash, but you can only redeem it by making the payment into a bank account. And by doing that, you're avoiding something. You're making the check a little more secure than it would be when it does not bear the two parallel lines. So this indicates that the check can only be paid into a bank account and cannot be cashed over the counter. You cannot go to the counter and say, I have my check, please give me a check, give me cash. And yet the check has two parallel lines. The issuer has already protected that instrument, and he says, please only pay this money in a bank account and not cash. That is check crossing. Check crossing. There are two main types of check crossings. Normally, we have two main types of check crossings. We have the first one being the general crossing. General crossing. And now the general crossing, that is when the check is crossed with two parallel lines, and it is considered a general crossing. And that is the situation where we say that the check can only be deposited into a bank account and cannot be cashed by the holder. You cannot simply have cash when you're holding such a check that has two parallel lines. But we also have what we call special crossing. Special crossing. Special crossing. Now, special crossing, that means the check has a special feature. A special feature or a special crossing includes the name of a specific bank, the parallel lines, like a special bank where this amount has to be paid into. Someone is asking a question.
I'm not seeing the shared screen.
Even me, I'm not seeing the screen.
Yeah. Are you for real? What happened?
Yes.
Couldn't you communicate? Earlier on, I thought I was sharing it. Are you now able to see?
Yes.
You can now see.
Yes,
Yes,
thank you.
yes.
Okay. So we are saying that we have either general crossing and special crossing. A special crossing includes the name of a specific bank between the parallel lines. When you have this kind of crossing, this time around, if you have a check is like this, and it has been crossed with two parallel lines, here it will have DFCU. And once it has DFCU, this check can only be redeemed and paid into an account in DFCU. It cannot be paid to any other account within another bank. But if you have a check which has just parallel lines like this, that check, it simply means it can only be redeemed into a bank account, but it doesn't matter which bank. But it cannot be cashed over the counter. It cannot be cashed over the counter. So these two instructions are different. Where you find that it has a name of the bank in the two parallel lines, this simply means this check can only be redeemed into an account in this bank. Whereas here, the two crossings like this, they simply mean that it can be redeemed in a bank account and not using cash. So crossing a check normally helps to prevent fraud and ensures that the funds are deposited safely into the intended recipient's bank account. That is a feature that we normally use for purposes of protecting the instrument, which instrument is referred to as a check. Check endorsement. Check endorsement. Check endorsement. Check endorsement is the process of signing the back of a check before it is deposited or cashed. You have already seen a check and someone has signed on it at the back. Someone has signed on it. By signing on this check at the back, this is an endorsement. That is an endorsement. Check endorsement is the process of signing the back of a check before it is deposited or cashed. And the signature on the back of the check is called an endorsement. It is called an endorsement. And normally endorsing a check is necessary to transfer the funds to another party or to deposit the funds into the bank. It is necessary. When someone asks you, have you endorsed the check? It simply means, have you signed on the check at the back of it? And normally there are different ways in which this check is endorsed. Now, by signing on it, simply tries to show that this check is authentic. The issuer of the check is the one who endorses on it. The issuer of the check is the one who endorses on it. So once you're given a check, you can always ask that person, could you please go ahead and endorse this check before I present it for payment? So someone goes ahead and endorses on it. The person who has authority to do so is the one who actually does that kind of endorsement. That kind of endorsement. The other term that we normally find under reconciliation or under bank, surrounding these bank transactions is electronic. We have some electronic forms of bank payments. Whenever you go to the bank and you want to make a transaction, the bank or the teller will ask you, can we do an EFT? Can we do an RTGS? Is it a, say, is it a, can we just do a mobile money? Can we do a telegraphic transfer? etc, etc. All those are different electronic payments available to the bank to transfer funds from one account to the other. And each of them is used in different situations depending on what you desire as an individual. So let's look at real-time gross settlements. Real-time gross settlements, RTGSs. In fact, this is capital T. It is normally written as real-time gross settlements. In most cases, you've gone to the bank and you're requiring the bank to make an RTGS. What do they mean by saying RTGS? And how is it supposed to work? Now, real-time gross settlement is a payment system that allows for real-time transfer of funds between banks or financial institutions. It is a payment system that allows for real-time transfer of funds between banks or financial institutions. Now, when we say that it allows real-time transfer, what we are doing now, for example, what I'm doing now, if I can write here, if I can write immediately and you guys are able to see what I'm writing in real time, it means I am doing this teaching in real time and I am writing in real time there and then. I am writing and you're able to see what I'm writing in real time. Now, when you talk of real-time gross settlements, it means the payment is going to be transferred or the funds are going to be transferred in real time. The moment someone does the initiation, the money will be reflected on the other party's account immediately. Immediately. That is why we say real-time gross settlements is a payment system that allows for real-time transfer of funds between banks or financial institutions. Now, this is between funds or between banks or financial institutions. You're making a payment from DFCU and it is going to Centenary Bank. Because you're using an RTGS, the moment you transact, that amount is going to be reflected in the other bank immediately. So in RTGSs or in an RTGS system, transactions are processed immediately and are settled individually without netting debits against credits. So we have transactions which are being settled individually and in gross settlements. This means that each transaction is settled individually and in real time without any waiting period or batching of transactions. I have told you, every time we are looking at in RTGSs, the transactions are going to be settled in real time. Number two, the transactions are going to be settled individually. Number three, there is no batching of transactions. We're not going to have a number of transactions which are going to net in terms of debits and credits for them to actually settle. And we do not have any waiting time for these transactions, RTGS. They are instant transactions. As long as the banker or the teller has initiated this transaction, the transaction will happen there and then, and the money will be reflected on the other party's account immediately. Immediately. So RTGS systems are typically used for large volume and time critical transactions. You expect that where you have large volume and time critical transactions, an RTGS is a preferred mode of payment. So don't be here tomorrow after studying this bank reconciliation and these different modes of payment, and then you don't understand which one can I use. Can I use an RTGS? Can I use an EFT? Can I use mobile money? you must know how does it operate, and the choice is yours to transact and also advise another person that if you want to receive this money immediately, let's go for an RTGS. But of course, you understand, as long as something is good, it will always attract some cost. So RTGSs are normally expensive as compared to EFTs, mobile money, and the others. So we say an RTGS system or RTGS systems are typically used for large volume and time critical transactions where immediate and irrevocable settlement is required. The moment you have initiated the transaction is successful. And once it is successful, then you can't recover. You cannot, it is irrevocable. You cannot call back the money. It has already gone. It has already gone and settled immediately. It has already gone and settled immediately. Some of the examples that, some of the transactions that are commonly processed through RTGSs include interbank transfers, where you want to move money from one bank to the other, large volume commercial transactions, where you have large volume transactions, such should be used or transacted using RTGS. Then payments in financial markets, in most cases, they are also used using these RTGSs, etc., etc. So we should be in a position to understand how these RTGSs do work. I'm just explaining. You read the rest and make more meaning out of what I'm explaining. Number 2 is electronic funds transfer. This is very common. These are EFTs. Those are EFTs. EFTs. How are these electronic funds transfers different from RTGSs? Now, one, in terms of cost, RTGS are expensive as compared to this. Number 2, RTGSs are in real time. These ones will take 1 to 3 days. Number 3, these ones normally, okay, they handle both batches and individual transactions. RTGSs normally do individual settlement of those transactions. And RTGSs are normally intended for large volume transactions. These ones can do even small transactions. So that's the difference. So what are electronic funds transfer transactions, or EFTs? Electronic funds transfer refers to the electronic transfer of money from one bank account to another, either within the same financial institution or between different institutions. So we use electronic funds transfer where we transfer money from one bank account to another, either within the same financial institution or between different financial institutions. Now, we also say that EFTs are commonly used for various types of transactions, such as paying bills. When you're paying your umeme, when you're paying water, when you're paying, airtime, etc., etc. School fees, EFTs are normally good for such transactions. And sometimes when we are receiving payments, when there is a case of receiving money, then we can say that indeed we can use EFTs. EFTs can be processed through different channels, including online banking. Those of you who have done them, or those of you who do online bankings, some of the channels that you can look at is online banking. For example, I'll tell you that whenever we are making payments as our professional business school, we use online banking. There is no need for me to go and interact with the teller. My colleague will initiate and I approve, or I initiate and another colleague approves. So with the EFTs, there is no interaction between me, the person who is initiating this, and the bank person. We do these transactions online without necessarily reaching out to the bank. So EFTs can be processed through online banking, mobile money, ATMs, and other electronic payment systems. And we normally say that the process typically involves the sender initiating the transfer by providing the recipient's accounting information and the amount to be transferred. You should be in the position to specify on whose account is this money going. The initiator has all those details, and at the end of the day, he also has the amount that has to be transferred. The funds are then debited from the sender's account and credited on the recipient's account. And this normally takes place within 1 to 3 days, business days, 3 business days. Those are EFTs. Maybe the other thing I can say regarding these EFTs, that in most cases, these are considered as a safe and convenient way of transferring money. It is a safe and convenient way of transferring money as they eliminate the need for paper checks. We do not have any kind of paper checks. In other words, they reduce the risk of errors and fraud. They reduce the risk of errors and fraud. And we know that they are widely used for personal and business transactions, offering a fast and efficient way to move funds electronically. So those are EFTs. So in the event that you actually need to make such payments, the different bills, small transfers, payments of salaries, payment of your clients, you can always use EFTs. And the EFTs are not that so much expensive. And secondly, you can control it in your office without necessarily moving from your office to the bank, because such transaction can be initiated. As long as you have one to initiate and another to make the payment, then that can make the approval, then that can be used immediately. Telegraphic transfers. Now, these are some of the things where you approach the bank and the bank are asking you, are you doing an FT? Are we doing an RTGS? Are you doing a telegraphic transfer? So you ought to have knowledge behind each of these different payment modes. TT. Now, a telegraphic transfer is used for electronic transfer of foreign currency funds from one party, who is referred to as the remitter, to another party, who is referred to as the beneficiary. So in this case, we are simply transferring foreign currency funds. You want to transfer from Uganda, Ugandan shilling, and the money is going to an account in Kenyan shillings. So in other words, you're transferring Kenyan shillings. That is what we are saying, that it is a term used to transfer, or it is a term used for electronic transfer of foreign currency funds from one account or one party to another. And fees are often charged by the remitting bank, which is the bank that is sending. The one which is sending is actually the one that is charged. Otherwise, the other party who is going to withdraw will receive the net amount. So telegraphic transfer, in case you have issues to do with transferring foreign currency funds, then it is probable and proper that you use these telegraphic transfers. Mobile money, all of us understand this. Mobile money as another form of transferring money. I don't think there is anyone who has not transacted using mobile money in this class. But we also know that mobile money is known as money transfer person to person, person to person, or mobile remittances. And normally it is a service that allows unbanked money to be sent to another person. So in this case, we are saying that unbanked people to is a service that allows unbanked people to send or receive small funds of money to and from any other mobile user. Kevin will send money to Awa. Ruto will send money to probably Peter, etc., etc. From one mobile number to the other. From one mobile number to the other. And in fact, these days, even if you're sending money from MTN, it can be received on Airtel. So within the country and outside the country, it has worked, and it is very, very working and efficient. So those are some of the 4 that we can discuss. Mobile money. Those are some of the 4 different payment methods that are available, which can be used for purposes of transferring the funds. Number 5, reconciling items. Now, when we start reconciling items, we have started the real bank reconciliation. The first electronic funds and the check system, those are not applicable. They are terms used under banking systems, but then reconciling items, they are very, very critical because we shall see them in the state. These are the ones which bring about the disagreements in the two. Reconciling items, we are saying that these are items that bring about a disagreement between the cash book and the bank balance. Reconciling items are the items that bring about a disagreement between a cash book balance and a bank statement balance. And some of them that we have unpresented checks. Unpresented checks. What are unpresented checks? We normally say these are payments that have been effected and recorded in the cash book. Recorded and effected in the cash book. In the cash book. But the payees have not yet received the checks to the bank for encashment. The payees have not yet presented the checks to the bank for encashment. Now, what happens here? In this case, you're paying out money to, say, your suppliers. And the moment you're paying out money to your suppliers, the moment you hand out a check to them, you go ahead and record in your cash book that money has been paid out to the suppliers. In other words, in the cash book, you credit your cash book using the bank since it is a check. Now, as long as this supplier has not presented this check to the bank can never know that there is a payment which has been made. Therefore, it simply means that indeed this check remains unpresented. That is where we're saying that these are payments that have been effected and recorded in the cash book, but the payees have not yet presented the checks to the bank for encashment. They have not yet presented these to the bank to be paid. And therefore, the bank has not made any such a transaction. And in such cases, there is no record of payments in the bank statement. By the time you correct your bank statement from the bank to make a reconciliation with your cash book, this payment has not yet been captured. So you have that check that you have issued, but that check remains unpresented. Unpresented checks are those checks which have been effected, clearly recorded in the cash book, but the payees have not yet presented these checks to the bank for payment, and nothing like a record is appearing on the bank statement for such unpresented checks. We have what we call direct. This is number one. Number two, we have direct debit or direct credits. Direct credits, these happen in the bank. And we are saying that here some data is paid directly into the bank account. However, these recipients don't appear in the cash book. Someone pays you money and deposits it direct on the account. For example, you students, some of you normally deposit money on our account directly. You deposit money on our account directly, but then as long as we have not reconciled that money, as long as you have not told us that you are paid, sometimes it's not going to be very easy for us to know that it is so and so that paid money. We won't tell that it is Salama that paid money. It is so and so that made a payment. Not until you come out and give us evidence that indeed you deposited money on our professional business school account. So such direct deposits that are made onto the bank account are referred to as direct credits. Money is credited onto the account directly without the know of the person handling the cash book. We have uncredited checks. Now, uncredited checks, these are checks deposited and recorded in the cash book, but have not yet been credited into the bank account. You have been paid by your customers. The debtors are paid, and they are paying you using check. So once you receive that check, you go ahead and record it in the cash book. But you have not presented such a check to the bank, meaning that it is uncredited. It is not credited on the account. I want you to draw a difference between unpresented checks. Unpresented checks are given to those that are paid, the suppliers, the trade payables, your suppliers, those who are supplying you with goods. They're the ones you're giving these unpresented checks. These checks remain unpresented by them. When it comes to uncredited checks, it is our customers who are paying us. They are giving us checks, but we record them and we haven't taken, by the time we reconcile, we have not taken them to the bank for transferring the bank into our account. So there is no credit in our account for such money that has been received. Number 4, we have direct debits. Please ask where you have not understood. Position 2, explain and you understand it. Direct debits, similarly or similar to the direct credits where money is deposited into our account, there are cases where money will be removed from our account without our notice. For example, bank charges. So direct debits, these are payments that are directly made by the bank since no check is written for such payment. For example, we have what we call standing orders. We have payment of utilities like water, electricity, bank charges, interest charged, etc. All those can be direct debits onto your account without you notifying, without you getting notified by the bank. The bank will simply effect such transactions, and then once you get your bank statement, that is when you can know that there were some bank charges that were charged, there were some interest charges that were made, etc., etc. Dishonored checks. Dishonored checks are checks that the bank has rejected. Either way, it could be you receiving the check, you take to the bank and it is dishonored, or you're issuing a check to your suppliers, and once those checks are presented to the bank, they are then dishonored. Once these checks are presented to the bank, they are dishonored. So dishonored checks are checks which have been rejected by the bank, which has been rejected by the bank. Again, because of differing signatures, a check can be rejected. When we have insufficient funds on the account, that check can be dishonored. When we have a difference between the wording and the amounts in figures, all those are some of the reasons as to why a check might be rejected. Some checks may be stale or may be presented before their due date. There are those who have expired. You are supposed to present this check in 1 week. You present it after a week. That will be a stale check. Or you're supposed to present the check after 3 days and you present it before those 3 days. All those checks can be dishonored. The other thing that would bring about disagreements are clerical errors. Now you have to note that at all times, you should be in a position to know the different transactions that have to be corrected in this bank statement. You have got to know how does this affect either the cash book or the bank statement. Either the cash book or the bank statement. So you must know how that is meant to be done. So clerical errors are the normal mathematical errors that we normally commit in preparing our cash book or compiling the bank statement. And once you find such errors, then those errors must also be corrected. They must also be corrected. Must be corrected. Steps of preparing a bank statement, a bank reconciliation statement. Members are not asking. I don't know. I told you, whenever I am teaching and the members are not asking any questions, there are two assumptions. Either you're not picking anything to the extent that you can't even have a question to ask, or you're picking everything and you're understanding everything. So for me, when you don't ask, the assumption would be that indeed we are picking everything.
Excuse me, Mr. Fred.
Yes, you are excused.
For that dishonored check,
Yes.
is there a specific period? Suppose my customer has written for me a check to be presented to the bank. And maybe on his account, he doesn't have sufficient money. And he keeps on telling me to wait until he deposits some money on his account. Is there a specific period that that check can take to be dishonored by the bank in case I take long to present it to the bank?
Now it will depend, because I've told you checks normally, it depends on the arrangement or the agreement you have. Once you have issued this check, it can have an ending date. You can find that you can have a check which has a specific period within which it has to be redeemed. Now, if that check is brought and the time has already expired, then it will be dishonored. But if the check is open, it can be redeemed any time. then it is up to you. You, the recipient, it is you to know when you want that money, and that is when you present that check to the bank. Otherwise, normally what happens, members use checks as a mode of finance. Someone issues a check, which check has got to be redeemed after 2 weeks. So in one or the other, someone is using a delaying tactic. He has a delaying tactic for purposes of, gathering the funds here and there. He knows that even when this is taken in the bank, it will be delayed to be redeemed. So he's buying some time in one or the other.
Okay, thank you.
So steps in preparing bank reconciliation statements, we have one, we've got to check whether we have any outstanding items in the previous reconciliation on the new bank statement. One, check for outstanding items in the previous reconciliation on the new bank statement. I have told you, you have cases where you had unpresented checks and uncredited checks. If that happened, before you actually do this new reconciliation, first check on the bank statement and see those that were previously issued in the previous period, are they now on the bank statement? If they are, then make the necessary reconciliations for such. So check for outstanding items in the previous reconciliation on the new bank statement. Those that you had reversed, those that you had, showed as unpresented or uncredited, are they now on the new bank statement? If they are not there, then you can ask, why don't you have? You can either reach the client who you had issued, your supplier to whom you had issued a check, or you reach out to the bank and ask them, I issued a check in such and such a period. Why isn't it being seen on this bank statement? Number two, we have got to compare deposits and payments on the bank statement with records in the cash book.
Excuse me, sir.
Yes.
Let's say you're dealing with the month of January. Then you
Yes.
have unpresented checks for January. Then when you go to Feb, you find them on you find them corrected on the bank statement. Do you go to Jan and clear Jan, or you clear them in Feb?
Now what happens? You're going to clear them in Feb because the bank has also cleared them in Feb. You get it? These, you had issued them in January and you recorded in your cash book that you had paid out money. Now, for January, when you're making a reconciliation, you find that previously, when you recorded this transaction, you credited your cash book to show that money had moved out. Isn't it? Now, when you're reconciling, you find that in the bank statement, you don't have such. And so there is no money that moved out. You do not have any money that has actually moved out because these people have not presented this check to the bank for payment. Therefore, you're going to, in January itself, when you're making a reconciliation, you're going to add back these unpresented checks. The balance that you have as per the cash book or as per the adjusted cash book, you're going to add back these unpresented checks, something that shows that indeed there is nothing like a transaction which showed that money moved out. Previously, you had credited the checkbook. Now, when you're making an adjustment on the cash balance, you'll be adding back to show that I'm reversing the transaction, which actually was showing that money moved out. I am adding back to show that there is no money that moved out. So you have done that in January. You have reversed this transaction in the reconciliation. Now in Feb, when these are actually presented, money has moved out. You must also go ahead and show that indeed we have money that has moved out in our cash book in that month of Feb. Am I clear on that?
Yes.
Good. So number 2, compare the deposits and payments on the bank with the records in the cash book. Now we want to see, we are checking to understand, do all the transactions that appear in the cash book as transactions that have been cleared in the bank, are they actually appearing on a bank statement? If that is so, then we are comparing. Now, if I have some auditors in here, this is something that is very crucial. You can never do an audit where there is payments, where you have some payment and you finish the payment, sorry, you finish the audit without doing a reconciliation. You need to check the reconciliations and see, were they done in the right way? Are they relating to the right periods? Okay. Are there no errors that were committed within the reconciliations? So as an auditor, you must always do this reconciliation. Some of the analytical procedures that you take are those ones when you recalculate some of these transactions to see exactly whether indeed these were effected in a right way. Every time you're doing these substantive procedures, analytical procedures, in the reconciliation, you recalculate to see, is it a right reconciliation that was done? Is it a right reconciliation that was indeed done? So number 3, deduct from the balance as per the cash book any direct debits. In our corrected or adjusted cash book, we shall always deduct the direct debits because we want to show that money that was actually debited onto our bank statement without our know, we go ahead and deduct it. And if we have any direct credits where we received any monies without our know, we shall go ahead and debit it in the cash book to show that we indeed received some money. Determine the adjusted balance as per the cash book, which should be the same as the balance as per the bank statement. So the reconciliation at the end shall provide a balance, which balance should be exactly the same balance that you have on the cash book. And then where you have transactions that would need to require any journals, when I talk of journal entries, I am meaning the debit and credit, you pass them. Prepare journal entries for items on the bank statements not yet in the cash book. You go ahead and journalize them. Now, there are 2 different ways on how we can do a reconciliation statement. That is 1, when we start with the cash book balance, and 2, when we start with a bank statement balance. Now, when I start with the procedure in preparing a bank reconciliation statement. One, starting with a cash book balance. Starting with the cash book balance. So cash book balance here. Assuming we have shillings in 1,000, then we shall have adjustments for cash book errors. Remember, the errors can be added or subtracted depending on the effect of that error that was committed. We add direct credits. And we also add unpresented checks. I am going to illustrate more for purposes of clearly understanding these checks. Then we less uncredited check. We less uncredited checks. Then we shall have bank balance. So this is bank statement balance.
How about direct debits?
Direct
Direct debits.
Direct debits are supposed to be less. I have not listed them here. Okay, less direct debits here. They're supposed to be list. So you list them. So where we are listing uncredited and direct debits. The rest we are adding. And the errors that are committed are supposed to be adjusted in one way or the other. That is the situation when you start with the cash book balance. We are going to do some examples to this effect. And this is the commonest when you start with the cash book balance. Normally, that is the commonest that we find in the exam. Number 2, when you start with the bank balance. Starting with the bank balance. So we shall have bank. This bank. On this we add uncredited checks. We add direct debits. It's the opposite of what I've seen now. We less direct credits and less unpresented checks. Less direct credit and less unpresented. Less unpresented. So we shall have cash book balance. Let's try to understand each of these transactions, why we are adding and why we are subtracting. Let's try to make a meaning out of them. Now, at this point, I am looking at, starting with the cash book balance. I am looking at a situation where I have a cash book balance that has some issues. In my cash book, normally, we don't prepare it this way. We shall be required to come up with adjusted cash book. And then here I have a bank reconciliation statement. So if I have to come up with an adjusted cash book, if I have any balance from the previous cash book that has been provided, which has issues, it is what I'll start with here, balance forward. That is the balance that I have in my cash book, which has issues. Now, if I have any direct credits, I'll come and put them here. Direct credits. You add them here by debiting. This is what we said. When you start with adjustment for cash, sorry, when you start with the cash book balance, you add direct credits. You can say I am adding them. If I have any direct credit, direct debit, I'll come here and debit them here. Now, if we have any adjustments for errors can be on either sides. I can have errors here. I can also have errors this side. And of course, any other transaction that would affect my cash book. Now, I also have my bank reconciliation statement, and at the end of the day, when I have balance carried down, that is what I'm going to start with in my, it is what I'm going to start with in my reconciliation. So I'll come here and say balance as per adjusted. Please note this is my cash book. Balance as per adjusted cash book. So you come and say the balance current up. This one here is what I want to be here. That this balance here is what is coming here. That is the adjusted balance. That just cash book is that. Then on this add unpresented checks less uncredited. And then get balance. Oh, before I get balance, I can also expect some error here, which can be a plus or a minus. And then we can have the balance as per bank statement.
Excuse
Now,
me,
yes.
where do we put dishonored checks?
Now the dishonored checks won't be in this. This one is not conclusive. This adjusted cash book is not conclusive. This what I wanted to make here note is going to have note. Errors that have been made in the cash book shall be corrected in the adjusted cash book. This is number one. Number two, errors that have been made in the bank statement are corrected in the bank reconciliation. errors that have been made in the bank statement are corrected in the bank reconciliation statement, and the errors that have been made in the cash book shall be corrected in the adjusted cash book. So where you have, like she was asking, dishonored checks, we can have a dishonored check this side. But we can also have a dishonored check this side. So these transactions are not conclusive because those transactions normally depend on what has actually been provided. So where I said we are starting with a cash book balance, it means we have done this cash book and come up with it here. Then we add unpresented checks, then uncredited check, and the errors, if any, then to have the balance per the bank statement. And this is the commonest that we normally do, because at all times we know that we actually have the information to do with the cash book and the bank statement. But then you can also use this other one where you start with the bank balance. Now, when you start with the bank balance, the bank statement balance, and you say that add uncredited checks. Now, this means that you have started with adjusting the bank statement balance. All those that were not presented, it means go ahead and present them. And by presenting them, it means the balance is going to increase. Now, if I have uncredited, I'll ensure that these checks are credited. It is shown as if they were credited, because even in my cash book, the cash book is showing that I received the money. So even here, I'll go ahead and have them credited by adding here. When I have direct debits, it means there is money that went off in my account, which does not show in my cash book that indeed there is money which was deducted. And because this money we had debited, showing that money had moved out, by adding back these direct debits, it shows as if there is no money that had been moved out. That is why we are adding back. And when we get to less these direct credits, when you were showing that there is money which was received in the bank, there is no transaction that is appearing in my cash book. So because there is nothing like a transaction in my cash book, then I'm going to less this money which came in from the balance that I have in my bank. My unpresented checks. In the cash book, we are showing that we paid out money, but in the bank, they are not reflected. There is nothing that shows that indeed money was paid out. So what we're going to do, we present them and we less that money because it has got to go out. This is what we are doing by saying that you less. When you less, indeed what you get here should be the balance that you have in the cash book. It should be the balance that you have in the cash book. So you can always start with the bank statement balance, or you can start with the cash book balance. And the end of the two will give you right reconciliations. Right reconciliation. So let's look at an example. Let's look at an example. The one that we have in the reader. And it is the only example we are going to do today. Then on Thursday, we shall do another example from the question bank and another question from errors. And I will ask the class coordinators to arrange and have those two questions, which we shall do on that day. You look out for those two questions, one from errors that you would wish me to do for you from the question bank, and one from the from bank reconciliations, and you share with me. Otherwise, if you don't, me, I will just pick out any question from errors and any question from bank reconciliation, and then I do for you. Example. Example, the accounts assistant of Money Limited, maybe before we do this example, these questions are normally set in two different ways. One, like this one that we are seeing here, where we have been given statements of what transpired in specific transactions that were supposed to be handled. But then there is a situation where the examiner is going to give you a cash book and a bank statement, and then you're required to reconcile the two. So in that example that we shall do in class, I will beg that it comes from the other area where we are given a cash book and a bank statement, so that we have knowledge in the two areas. The accounts assistant of Money Limited had just completed preparing the draft financial statements for the year ended 31st December 2012. The accounts assistant of Money Limited had just completed preparing the draft financial statements for the year ended December 2012. On the same date, the cash book showed a debit balance. Cash book showed a debit balance of how much? 24,450,000. Subsequently, the following issues came to light. Note number one, checks amounting to shillings 5 million paid to the suppliers had been entered in the cash book, but had not yet been presented to the bank for payment. Which check is that?
Presented check.
We have unpresented check, but they are saying that checks amounting to 5 million paid to the suppliers had been entered in the cash book, but had not yet been presented in the bank for payment. So that is unpresented. And we said when we start with the cash book balance, we shall go ahead in the reconciliation and add back that. Note number two, checks from customers totaling to 14.45 entered in the cash book on 31st December 2012 were not credited by the bank until 3rd January 2013. Which check is that? Sorry?
Uncredited check.
It is an uncredited check. It is an uncredited check. In other words, this check specifically had been properly received, recorded in the cash book, but we had not taken it to the bank to credit our account. Note number three, the bank had charged ledger fees amounting to 1.6, which amount appeared in the bank statement obtained from the bank on 31st December 2012. However, this amount had not yet been credited in our cash book. What kind of a transaction is that?
That is a direct debit.
The bank had
Is a direct. That is a direct debit because the bank had removed that on our account. On our account, it's debit. So the bank did a direct debit by removing 1.6, but nothing was appearing in our cash book. So that must be debit. It must be a credit in the cash book. It must appear on the credit side of the cash book. Note number four, a check for shillings 64,500,000 for new furniture had been mistakenly entered in the cash book and the furniture account as 14.5 million. A full year's depreciation of 10% had been charged in the statement of comprehensive income on the in respect of this furniture. You can see we have some error here that was committed. It is an error. In fact, it is an error of undercast. Bank reconciliations and errors have a relationship. Because once an error has happened, it is an error in a financial transaction or in an accounting transaction. So the same way you're seeing it here can come under errors. And they're telling you that a check of shilling 64.5 for new furniture had been mistakenly entered in the cash book and furniture account as 14.5. And then they talk about depreciation. In this case, we are not going to look at depreciation because we are looking at cash coming in and cash moving out. But once we are in errors and suspense accounts, a full year depreciation of 10% would have an impact on our journal. It would have an impact on our journal. So, in this case, we understated our cash that was paid out. We understated the cash book in terms of payments. We showed that less of the money, less payments were made, because they are saying that a check was meant to be 64.5. You were supposed to show that you had paid out 64.5 million. Instead, you only removed 14.5. So there is a balance. There is a balance which should indeed be shown as a payment. Which should indeed be shown as a payment. Therefore, we shall correct that in the cash book because it is an error which was committed in the cash book. Note number 5. A check for shillings 4.9 from a credit customer paid to the bank on 28th December 2012 was subsequently dishonored by the bank. Now, please note the word subsequently. A check for shillings 4.9 from a credit customer paid into a bank on 28th December 2012 was subsequently dishonored by the bank. It was decided that the debit be written off because the customer had become bankrupt. Now, the customer paid us a check of 4.9. We went ahead and recorded it in our cash book, but reaching the bank, we deposited that money. Subsequently, the bank noticed that this account or the customer did not have any money. And later, that customer was declared bankrupt. So, first of all, to correct this in our cash book, because we had debited our cash book to show that we had received the money, we shall create the cash book to cancel out the first transaction. But at the same time, the fact that the bank had received it, meaning that the bank had also showed that we had received the money, we must go ahead and less that transaction to show that no money was received. So it is going to be corrected in the cash book and at the same time in the bank reconciliation. We are taking it to the bank reconciliation because of this word. Subsequently, the dishonored check by the bank dishonored that check, meaning that they received the check and did the right transaction, but subsequently they realized the other person did not have money, and then it was later dishonored. So it is going to be corrected in the two statements. Next, number 6. Number 6. A check for shillings 12 million in payment for motor vehicles insurance had mistakenly been entered in the cash book as a debit and posted to the credit of the motor vehicles account. Depreciation of 25% per annum is charged on the balance of motor vehicles account at the end of each accounting year on 31st December. a check of shillings 12 million in payments for motor vehicle. So that was expected to be credited to the cash book. Instead, we debited, it was mistakenly entered in the cash book as a debit. We were supposed to show that money had moved out in the cash book. Instead, we showed that we had received money. So we must reverse that transaction by recording on the corresponding entry. Recording on the corresponding entry. And also going, we cancel out the transaction and also going ahead to actually write the right transaction. This was an error of complete reversal because even in the motor vehicle, we did a wrong transaction. We credited, and yet we were supposed to show that money was, we had bought an asset. So that is going to be corrected in the cash book. Note number 7. The total of the payment side of the cash book had been undercast by 5 million. It was also discovered that the sales for the year were overstated by 5 million. This overstatement, it does not clearly specify whether it was a cash sale or a credit sale. So it has nothing to do with that. Apart from this first transaction, which says the total of payment side of the cash book had been undercast by 5 million. When they say it had been undercast by 5 million, it means we did not remove that money. So we shall go ahead and remove that 5 million. Note number 8. The bank had a credit. The bank had credited Uganda shillings 800 on the company's current account in standing instructions from the company in respect of interest on a fixed deposit account, and the company maintained the same bank. In accounting for this transaction, the bookkeeper had mistakenly entered in the payment side of the cash book for this amount and had posted it to the debit of interest payable account. So all these, by the way, all these errors you see here can be under the errors and suspense. So in this case, in accounting for this, a bookkeeper had made an entry on the payment side. We were receiving money, but instead this person showed it as a payment. So we shall cancel out that and also go ahead to show the right transaction. So let's prepare an adjusted cash book showing the revised balance, which should appear in money limited statement of financial position. And then B, we must also go ahead and show the bank reconciliation. So I'll come here and say money limited adjusted cash book. And then we can have money limited they said that the cash book balance had a debit balance brought forward of 24 shillings in 1,000 450. And note number 1, they said here, as we have our reconciliations, On this, we shall have to add unpresented checks with less and because here we have balance as the cash book. We shall have a balance there. This is going to be shillings in a thousand. You have it there. And if we have any errors, we shall have at the end, but from the bank. So let's try to look at the notes. Note number 1, check amounting to shillings 5 million paid to the supplier had been entered in the cash book, but had not yet been presented to the bank for payment. So the fact that in the cash book, we showed that there is money which actually moved out, but we ended the period only to check this money. This check had not been presented to the bank. Therefore, we must come here and add it. And it is 5 million. $5 million. That is in the reconciliation where we have unpresented checks. Note number 2, checks from customers totaling to 14,450 entered in the cash book. We had received that money and we had debited. We were not credited by the bank until 3rd January. That simply means we have no record in the bank statement. So there is no reason as to why we should go ahead and have it in the cash book, and yet we have no record in the bank. So on this balance, as per the adjusted cash book, we shall less that money to show that there was no payment. And lessing it simply means that we are actually subtracting it. When we say uncredited checks less, that simply means that we are removing that money. So since we had debited to show that we had received the money, that is why we go ahead and less from that. That is 14.5. Is it 14.5? 450. 14.450. Note number 3. The bank had charged ledger fees amounting to shillings 1.6, which amount appeared in the bank statement obtained from the bank on 31st December 2012. However, this amount had not yet been credited in the cash book. So this is a direct debit. Direct debits are normally put here. We shall say ledger fees, which is 1.6. Ledger fees 1.6. Direct debit. Note number 4. A check of 64.5 for new furniture had been mistakenly entered in the cash book and finished at 14.5. Yes.
And we're lessing those direct debits.
And when we are lessing, we credit the cash book. Are you getting what I'm saying? We are crediting the cash book to show that we are lessing this.
How about the bank reconciliation statement?
This does not appear in the bank reconciliation statement.
Okay.
Because it is already appearing on the bank statement as a debit. Therefore, in the cash book, we come and also less it to show that money went out. Okay? You remember what we did here? Direct debits, they are here. Direct credits are here. So in the cash book, since it is a direct debit, we credit it there.
Okay.
Next, let's move. We are saying that a check for shilling 64.5 for new furniture had been mistakenly entered in the cash book and the furniture account as 14.5. This was an understatement. The cash book was understated by removing less money. You must know what is the difference between 64 and 14. 64 and 14 point. So we must go ahead and remove the extra balance. And we say this is with respect to for furniture. The understated. This is 50. There's some noise that which is coming through. That is coming. So we are saying that a check for shilling 64.5 for new furniture had been mistakenly entered in the cash book and in the furniture as 14.5, meaning that there was an understatement. Instead of showing that you paid out 64, you only showed that you paid 14.5. So we go ahead and remove the balance as well to make it 64.5. In the other accounts, we are not interested in them because we are coming up with just the cash book and the bank reconciliation statement. So the information that has been provided is irrelevant to us. Information to do with depreciation, it does not concern us in this question. Pick relevant information only. Note number 5. A check for shillings 4.9 from a credit customer paid into the bank on the 28th December was subsequently dishonored by the bank. So we received the check and we recorded it on the debit side of the cash book that we had received. But later the bank dishonored it. And once the bank dishonors it, we come and also cancel out dishonored check. When we received it in the first place, we debited. So since it has been dishonored, we are going to credit it. That is 4.9. But the bank had also received it and did what it had, which it had to do. So because it subsequently notes that this person did not have money and dishonored it, it means they had recorded it, and therefore, even here also from our transactions, we must less this dishonored check. Please note that not all the time dishonored checks are going to be adjusted in the two, in the cash book and the bank statement. It is not the case. This case is special. We are doing it twice because they said subsequently the bank went ahead to dishonor this check. If you're looking at, for example, if you're looking at the cash book and the bank statement, and in the notes they say that a certain bank was dishonored, look at the cash book on the debit side. Is it there? If it is there, it shows that you received the check. If you go to the bank statement and check on the credit side, and you see that that check is also there, it means that the bank had received it and did what it was supposed to do to show that you had received the money. And if in the narrative they are showing, in the additional information they are showing it was dishonored, then that must be adjusted both in the cash book and in the bank reconciliation statement. But if you see a check in the cash book and it is showing that it was giving you money, and later it was dishonored, and it is not shown anywhere else, correct it in the cash book alone. correct it in the cash book alone. We only and only correct it in the two statements if at all we find that it affected our transactions in both the bank statement and the cash book. So here we shall list it. I hope I have communicated on that.
I have a question.
Please ask.
So according to this statement, them saying it was subsequently dishonored by the bank. Does it mean it was already credited in the bank?
Yes, that is what it means. It means that the bank had received and credited the bank statement. Oh, it had increased our amount that we had received 4.9. But subsequently, they discovered that there was an issue. Remember, in the bank crediting or debiting, it is upon confirmation that this person has money from their account. And once they confirm that this person has money, then they pass a credit. Now, this time around, the person credited our account before confirming that this person had money on their account. Upon confirming that this person did not have money, then they dishonored the check. It means that transaction must be reversed. So this is the reverse that we are doing now. Is that okay? Yes or no?
It's okay.
Good. So we have had our check here, dishonored, and even the other side. Let's move ahead. A check, not number 6. A check for shillings 12 million in payment for motor vehicle insurance had mistakenly been entered in the cash book as a debit and posted to the credit side of motor vehicles account. In errors, of course, this must be removed from motor vehicles account because it has nothing to do with the motor vehicle account. It is a payment for insurance. In other words, we would be debiting our motor vehicle insurance expense account and crediting suspense and twice, you must do it twice because this is an error which had been committed on the wrong side of, it had an impact. It understated your motor vehicle asset account. So that must be corrected through the suspense. But at the same time, for us, we are interested in this check because we are looking at cash coming in and cash moving out. So those other accounts, issues to do with the suspense account, issues to do with the motor vehicle account, it is none of our concern. Our issue here is when we are looking at the cash book. So we are saying that a check of 12 million in the payment for motor vehicle insurance had been mistakenly entered in the cash book as a debit. We instead showed that money had come in, yet in actual sense, it was supposed to be paid. So we overstated our cash book by debiting it. So we're going to cancel that and also go ahead to do the right transaction. So come and say motor vehicle insurance. Expense. That is going to be 12 million times 2, which gives us 2.4. 12 million times 2, which one transaction to cancel out the overstatement on the debit, and the other transaction is the right transaction, which is supposed to show that money went out in respect of that expense. Note number 7. Note number 7. The total of the payment side of the cash book had been undercast by 5 million. The total of the payment side of the cash book had been undercast by 5 million. It means we had not removed this money. So undercast, we go ahead and remove the money, 5 million. They go ahead and say it was also discovered the sales for the year were overstated by 5 million. That one has nothing to do with our cash book or reconciliation. So it is irrelevant. If you are looking at errors and suspense, then that would make sense to us, and we would have to go ahead and cancel out that over statement. But because it is cash and reconciliation statement, it does not make any sense to us. Note number 8. Note number 8. The bank had credited shillings 800 onto the company's current account in the standing instruction from the company respect of interest on fixed deposit account of the company maintained in the same bank. In accounting for this transaction, the bookkeeper had made an entry on the payment side. We received the money 800, so we are supposed to show in our cash book that we had received the money. So that was a direct credit. So in showing it, we instead credited our cash book, which was wrong. So we must cancel out that understatement by crediting, like the credit is going to be cancelled out and also show the right amount. So we shall come here and say interest on fixed deposit. That is 800 times 2. One transaction is to cancel out the payment that was showed, and the other transaction, the right transaction, which gives us 1.6. Which gives us 1.6. There being no other transactions, we shall balance off this account. We shall balance off this account. We add what is on the credit and what is on the debit. What is on the credit seems to be a little much more. So I have 1.6 plus 50,000 plus 4.9 plus 2.4, 24,000 plus 5 million. That gives us a total of 129,600. It gives us a total of 129. Is it 129,600? Check. 1.6, 50, 4.9. This is, I had put a wrong one. I had put 49. It is 4.9. So it is 85. For me, 85,500, right? Is it what you members have?
Yes.
Okay. So when I add this side, it should be the same, 85,500. When we less on that, we shall have a balance carried down of 24,400, 24,450 minus 1.6. We have 59,450. 59,450. And the fact that it is on the balance carried down, the fact that it is appearing on the credit side, it simply means the balance brought forward is here, the 59,450. And that is a loss. That is a negative balance. That simply means we spent much more money than what we had. And this is going to be in brackets here as we start. Balance as per the cash book, it's going to be 59,450, but in brackets. 59,450, but in brackets. So we shall have to go ahead and adjust it for these transactions. We adjust it for those unpresented. We said we added them. Uncredited, we said we less them. Less uncredited, this is in brackets. Less this dictionary check, and then we shall be in position to get the balance as per the adjusted, as per the bank statement. So I have negative 59,450 plus 5,000 minus 14,450 minus 4,900. That gives us a balance of 73,800, but in brackets. We removed much more money from our bank than what we actually had. That is why you see that we have that balance, but it is less. Rachel, did you attend today's class? Is she available? Rachel Ma? Is Rachel there?
She's there.
Yes, sir. She was there.
Get us 2 questions. One from errors and suspense accounts, and one from the other part of the other part of the bank statements or bank reconciliations, where we have been provided with a cash book and a bank statement. And then you share them before Tuesday. You share them before Tuesday. Use this time now. The remaining time, even tomorrow, even Monday, and get 2 questions. Those 2 questions, I'll do them on Thursday.
Okay.
I'll do those 2 questions on Thursday. We shall have a combined class on Thursday. So we shall revise these 2 topics on Thursday. We shall revise the errors and suspense accounts and also bank reconciliations on Thursday. And if time allows, we can do 3 numbers on that day. 2 numbers from errors and 1 number from bank reconciliation. So I want to call it a class unless there is a question such that we leave a little early.
Excuse me, sir.
Yes, you are excused.
On Thursday, what time will the class be?
Our Thursday class normally happens from 6 to 9.
Okay, then. Thank you.
6 p.m. to 9.
Excuse me, sir.
Yes, you are
Online.
excused.
My question is, when you are giving us the format for preparing the bank reconciliation statement, it seems as if you gave us 2 formats, that starts with the cash book balance and that starts with the bank balance. And when we were answering this question, it looks like we did two separate things, but using the same format.
2 separate things using the same format.
I don't know whether my question is clear. In the second format, you said you add uncredited checks. But in the first format, they said you less uncredited checks. So which one were we using?
That is the first one. Here. We were using this one here. Now, the only difference, the one thing you have to understand is that when we start, this one here specifically combines both the cash book and the bank reconciliation statement, this one here. But the questions that are asked in most cases would require you to come up with adjusted cash book and a bank reconciliation statement. Now, this is a combination of both. That is why we don't follow it. And indeed, what we have done here is clearly bringing out what we have had. This part here, when you come up with adjusted cash book together with the bank reconciliation statement, this is part number 1 here. That is when we start with the cash book balance. The cash book balance being this one that we are starting with, you make these adjustments, then you come to the bank reconciliation, you add the unpresented and less unpresented with, if there are any errors, you bring them, and then you come to the bank, the balance by the adjusted bank statement. That is number 1. But the situation where the bank can ask you with the bank statement balance. Make those adjustments until when you arrive at this book balance. How are you getting me?
Yes.
Now? Good.
Yeah. Thank you.
So that is what we have done. Any other question? Today I want to surprise you by leaving early. I always leave late. So if there are no questions, so on Wednesday for the evening class, we shall be looking at inventories, IS2. And then Saturday, we shall be looking at still inventories, IS2, in the weekday class. Sorry, in the Saturday class. So those doing QT, if you're ready, we can start now and we finish the class early.
Yeah.
Yes. Okay, have a yes.
Excuse me, I want to copy this. The format of cash. I just said one.
You want to copy the format of this one here?
To copy that. The format of the adjusted cash book.
It is there.
Yeah.
Only that you need.
That one there. Kindly just pray for me for a few minutes. I will finish and
I think that is enough. We can call it a class. Have a good day. And for the accounting, please enjoy Easter.